Okay, let's unpack this. Right now, we're talking mid-2025 and the global oil market.
Well, it feels like it's in a state of constant flux, doesn't it?
It really does. It's this incredibly complex web.
Yeah.
You've got supply, demand, geopolitics all tangled together.
And there's one country that always seems to be right in the middle of that complexity, especially when things get tense in the region. I mean, Iran.
Absolutely. Iran is central to so much of what happens, particularly with recent volatility.
So this deep dive, we're going to really focus on understanding Iran's position in the oil landscape right now. We're using the source materials you've brought together for us.
That's the plan. We want to peel back the layers, look at the hard numbers, production, exports.
And their strategies too, right? Like refining more oil at home. And crucially, where is this oil actually going, especially with sanctions in place?
Exactly. And we have to talk about the impact of recent events. Those attacks on energy infrastructure, for example. What does that really mean?
And if Iran's supply does get disrupted, who could even step in?
Yeah.
Who has the spare capacity? All right, we need to look at that. Plus, there's this fundamental tension, isn't there, between what the U.S. wants for oil prices and what OPEC Plus wants.
That clash of interests and how Iran sort of fits into that whole dynamic. It's fascinating.
It really is. So the mission here is to give you, our listener, a clear picture of this high-stakes game.
Okay, so what are the key points we'll hit? Lay it out for us.
Right, we'll start with Iran's own situation. Production numbers, those refining goals we mentioned, and how their exports are actually flowing.
Then the buyers, especially China.
Definitely. We'll zoom in on China, why they're so key, and this whole business with the teapot refineries, how that works.
Okay. And Iran within OPEC plus there.
Yep, how they fit into that broader alliance picture. Then those recent attacks, what was hit? The impact on prices.
And who could potentially make up for lost Iranian barrels? Saudi Arabia, maybe others?
We'll explore that, and then really dig into that core disagreement. U.S. versus OPEC plus on where oil prices should be.
And, of course, the role of sanctions hovering over all of this.
Can't forget the sanctions. They touch everything.
So the goal here is for you, listening, to get a solid handle on this complex topic quickly. Understand the key numbers, sure, but also the why behind the headlines.
Exactly. Not just the what, but the why. Let's dive in.
Okay, let's start right at the source. Iran's oil production. What were the actual volumes looking like as we kicked off 2025? What do the numbers tell us?
So looking at the data for early 2025, specifically January, Iran's crude oil production was sitting at roughly 3.28 million barrels per day. Let's call it BPD.
3.28 million BPD. Okay, and was that steady or?
Pretty steady. The figures show a tiny dip from December 2024, which was 3.293 million BPD. So basically holding around that 3.28, 3.3 mark. Relatively stable in the very recent term.
Okay, stable recently. But that number, 3.28 million, when you put it in historical context like the sources do, it tells a story, doesn't it? It's not their peak, but it's way up from some lows.
That's a really important point. The sources definitely emphasize this. This level, it represents a kind of stabilization after some really dramatic ups and downs over the years.
What were those extremes?
Well, think back to their peak production. That was, let's see, July 2005. They were pumping almost 4 million barrels a day, then 3.987 million BPD, according to the records.
Wow, nearly 4 million. Big difference.
Huge. Now, contrast that with a fairly recent low point, July 2020. Production just plummeted to 1.93 million BPD.
Less than half their peak. What drove that massive drop?
The sources are very clear on this. It was directly linked to the reimposition of those really tough U.S. sanctions under the Trump administration. They hit hard.
Right. So the 3.28 million we're seeing now is actually a significant recovery from that sanction-induced low point.
Exactly. It shows they've managed to bring quite a bit of capacity back online, even with restrictions still in place. But importantly, it's still well short of those historical highs, and definitely short of some of their past ambitions.
That history really underscores how much external pressure, like sanctions, can shape their output.
Okay, so that's extracting the crude. But what about processing it? Are they trying to do more refining domestically, building up that capacity?
Oh, absolutely. The sources make it clear that this is a major strategic focus for Iran right now. They're not just thinking about exporting crude oil.
They want to make gasoline, diesel, that kind of thing.
Precisely. They have some pretty significant goals for boosting their own refining capacity. The target mentioned is to reach a total capacity of 130 million liters per day of fuel, gasoline, and diesel combined.
130 million liters a day. When do they hope to hit that?
The goal is apparently tied to the end of their 14th government term, which is likely sometime here in 2025. So it's an ambitious near-term goal.
That does sound ambitious.
Yeah.
What's the strategic thinking? Why push so hard on refining?
Well, there are a couple of key drivers mentioned. First, it's about energy self-sufficiency. If you refine more at home, you rely less on importing expensive fuels, which could also be vulnerable to sanctions or other pressures. Makes sense.
Yeah.
Reduces vulnerability.
Right. And second, maybe even more important from a revenue angle, especially in this sanctioned environment, is that it opens the door to exporting refined products.
Instead of just crude. Does that make a difference?
It potentially can.
Mm-hmm.
Refined products might find different buyers, different markets, maybe command different prices sometimes. It could give Iran alternative ways to generate income and, work around some of the direct pressure on their crude sales.
Interesting. Are they actually building things to support this? New pipelines, refineries?
Yes, the sources point to concrete projects. They're investing heavily in modernizing the refineries they already have, trying to make them more efficient, boost their output,
And new stuff, too.
and building new facilities as well. The Hormozgan region is mentioned as a key area for new developments. Plus, big pipeline projects are part of this.
Like which ones?
The big one is the Gurjask pipeline. That's a 1,000-kilometer pipeline aimed at creating a new export terminal down on the Gulf of Oman.
So outside the Strait of Hormuz.
Exactly. That's the strategic point. It offers an alternative to their main terminal at Karg Island, potentially reducing reliance on the strait for some experts. It diversifies their options.
Smart move strategically. Any others?
There's also mention of a 460-kilometer pipeline heading towards Ras Sanjan, which probably helps with getting fuel distributed inland and maybe feeding other processing centers.
So it's clear they're investing serious resources into this whole refining and infrastructure piece. It's not just talk.
It really underscores a long-term vision. It's not just about pumping more crude. It's about processing it, controlling more of the value chain, and making their export routes more resilient.
Okay, so a dual strategy then. Recover crude output while building up refining. That logically leads us to exports. With sanctions still a major factor, where is all this oil actually ending up? And how much is getting out?
Well, despite those sanctions, Iran has still managed to keep significant volumes flowing outwards. The data points to exports being around 1.61 million barrels per day back in March 2024.
1.61 million BPD. How does that compare?
One source, Nikkei Asia, noted that was actually the highest level they'd seen since May of 2023. So it suggests a period of relatively strong export performance, showing they are finding ways to get oil to market.
So they're succeeding to some degree despite the restrictions. Where are they focusing their sales efforts?
The strategic direction, as laid out in the sources, is very clearly towards Asia, Africa, and Latin America. They're deliberately moving away from their traditional European customers.
Because Europe is enforcing sanctions more strictly.
Largely, yes. Many European countries stopped buying Iranian oil due to sanctions pressure. So Iran had to pivot to find new or expanded markets elsewhere.
Are there specific countries mentioned as key partners in these regions?
Yes, the sources specifically named China, Iraq, and Venezuela as being key destinations and partners for Iranian oil.
China's name pops up again. We'll definitely need to dig into that. But before we do, the sources had some really interesting details on how Iran prices its oil for these different markets. Talk about their OSP's official selling prices.
Right, this gives a fascinating glimpse into their tactics in a tough market. Looking at the OSPs for January 2025, one source detailed a clear regional split.
How so?
For their core Asian markets, where the demand is strongest and where, let's face it, most of their oil is likely going up sleeping, they were actually charging a premium. Iranian light crude was priced at $1.35 above the Oman Dubai average benchmark.
A premium, even with sanctions.
It suggests they have some pricing power or leverage with their main Asian buyers, maybe because the demand is reliable there.
Okay, but what about other regions like Europe or Africa where buying is trickier?
That's where the picture flips completely.
Ah.
For those markets, they were offering really significant discounts, up to $4.70 below the Brent crude benchmark.
Wow, nearly $5 below Brent. That's a huge discount.
It is. It clearly shows they have to slash prices dramatically to attract buyers in markets where sanctions are a bigger hurdle, or where customers are perhaps more price-sensitive or less conventional. It highlights the lengths they need to go to just to move the barrels in those tougher markets.
That differential pricing really tells a story, doesn't it? Tailoring the price based on who's willing or able to buy sanctioned oil. It's a direct consequence of the sanctions shaping their commercial strategy.
Precisely. You compete where you can command value, and you discount heavily where you have to, just to make the sale.
Okay, let's zero in on China now because, as you said, the sources just keep pointing back to China as absolutely fundamental to Iran's oil exports right now in 2025. Just how dominant are they?
They're not just a major player, they are the principal importer.
Yeah.
It's hard to overstate their importance. The volume they take is just enormous.
How enormous? What kind of numbers are we seeing?
Well, there's some variation depending on the source, which isn't surprising when you're tracking sanctioned oil. But one source, United Against Nuclear Iran, or UANI, they focus specifically on tracking sanctioned evasion, estimated China took in something like 1.8 million barrels per day of Iranian crude in March 2025.
Wait, 1.8 million? Didn't we say total exports were around 1.6 million earlier?
Good catch. Yes, that UANI number is higher. It likely reflects the difficulty and, frankly, the opacity in tracking these flows precisely. Different groups use different methods, track different things, maybe crude plus condensate, maybe different time frames.
But pinpointing the exact number is tricky.
Very tricky. But the direction of travel, the main point across all sources, is the same. Reuters, for example, put China's imports of Iranian crude at around 1.3 to 1.4 million BPD in 2025, and they explicitly stated that represents over 90% of Iran's total crude exports.
Over 90%. So regardless of whether it's 1.4 or 1.8 million BPD going to China, the bottom line is China is buying almost all of Iran's exported oil.
That's the inescapable conclusion from the sources, yes. They're overwhelmingly the main destination.
That is just remarkable, especially with sanctions supposedly trying to stop this. And the sources also showed how this relationship has changed over time, right? China wasn't always this dominant.
No, not at all. And that historical shift is really crucial context. If you look back, say, to 2010, before the really strict sanctions regimes kicked in fully often, China was a buyer, sure, but their share was much smaller, around 6% maybe.
Who else was buying back then?
You had significant volumes going to South Korea, about 10%. India took around 9%. And Japan and various European countries were also pretty big importers of Iranian oil.
A much more diverse customer base.
Completely different picture. Fast forward to today, 2025, Europe, gone.
Yeah.
Japan, gone. South Korea, India. Their volumes are way down in China's share. It's exploded to over 90%.
So sanctions basically forced Iran into China's arms in a way.
It heavily drove that consolidation, yes. As other buyers backed away due to U.S. pressure, Iran became increasingly reliant on the few major buyers still willing or able to take their crude, and China emerged as by far the most significant of those.
Okay, so China's buying huge volumes despite sanctions. Who exactly in China is doing the buying? Is it the big state oil companies? The sources mention these teapots?
Yes, the teapots. They are absolutely central to making this trade happen. These are independent oil refineries, mostly located in Shandong province. They're separate from the huge state-owned giants like Sinopec or PetroChina.
And why are they the ones buying the sanctioned Iranian oil?
It seems to come down to risk appetite and exposure. The sources suggest these smaller independent teapots are either less susceptible to, or perhaps just more willing to navigate, the potential consequences of U.S. secondary sanctions compared to the massive state-owned companies.
Because the state companies have more international ties, more to lose.
That's likely a big part of it. The state-owned enterprises have much greater exposure to the global financial system, international partnerships, things like that. The teapots are primarily focused on the domestic Chinese market. They see cheap Iranian crude as attractive feedstock, and they seem prepared to manage the complexities of buying it.
So the independents step in where the state giants fear to tread, essentially.
That seems to be the dynamic described. And to actually make these deals happen, to physically move the oil, the sources also talk about this reliance on a so-called dark fleet of tankers.
A dark fleet? Sounds cloak and dagger.
It kind of is. We're talking about ships that often turn off their tracking transponders or frequently change names or engage in ship-to-ship transfers out at sea. All sorts of tactics to obscure where the oil came from and where it's going. It's basically a shadow shipping network designed to bypass sanctions monitoring.
Wow. Okay, so it's the teapots buying, using this dark fleet. That UNI source you mentioned, it had some really specific data on these teapot buyers, didn't it, from February 2025?
It did. Incredibly detailed. It really helps to illustrate the scale and the methods involved. UNI published a table listing specific independent Chinese refineries, the estimated volumes of Iranian oil they took in February 2025, and crucially, the names the oil was supposedly rebranded as.
Rebranded to hide its origin.
Exactly. To make it look like it came from somewhere else, Oman, Malaysia, Iraq, even Russia or the North Sea, according to the list.
Can you give us a few examples from that table? Who are the big teapot importers mentioned?
Sure. Looking at that February 2025 data from Yuani, one refinery, Namu, was listed as taking in almost 40 million barrels, 39.79 million to be precise, across 29 shipments. And that oil was reportedly relabeled as generic crude, or Oman, or something called Nemina.
Nearly 40 million barrels to one refinery in 1 month. That's staggering. Who else?
Then there was Kadama, with about 38.9 million barrels over 25 shipments, supposedly rebranded as Nemina or Mal Blend. Mal Blend often suggests Malaysian origin, frequently used to mask Iranian oil. Falun was another big one, 37.1 million barrels in 31 shipments. They use a whole range of labels. Urals, which is Russian. Mal Blend again. Oman, even something called Blue Laser.
Blue Laser, okay, keep going.
Shengang Wama took nearly 33.6 million barrels in 20 shipments, rebranding it as Crude 40s, which is a North Sea grade Malaysia, or Bitumen Blend. And Shandong Yangqing received about 28.3 million barrels over 29 shipments, using labels like Oman, Iraq, Bitumen Blend, or Mal Blend.
Those numbers are just huge. And the variety of fake origins is quite something. What does this specific data, the names, the volumes, the rebranding, really tell us about this whole situation?
It tells us two really critical things, I think. First, it confirms beyond doubt China's deep reliance on this Iranian crude. This isn't some marginal side deal. It's major volumes flowing consistently to multiple key independent refiners. It's structurally important for them.
And the second thing?
Second, it provides concrete proof of the sophisticated methods being used to actively circumvent U.S. sanctions. The elaborate rebranding, the need for the dark fleet, these aren't accidental. They are deliberate tactics developed specifically because of the sanctions pressure. It shows that while sanctions aim to choke off Iran's revenue, determined buyers and sellers will find ways around them if the economic incentive is strong enough.
It really highlights the cat-and-mouse game being played. Sanctions are imposed, and the market adapts with these workarounds.
It's a constant dynamic, and it underscores just how challenging it is to fully enforce these kinds of restrictions when you have a major global player like China, or at least segments within its economy, willing to absorb the sanctioned product.
A clear picture of sanctions being actively navigated, maybe even defied, on a pretty grand scale. It's just part of the reality of Iran's oil trade today.
Absolutely fundamental to understanding it.
Okay, let's zoom out a bit now. We've talked about Iran's own production and exports. How does that fit into the bigger global supply picture, especially within that powerful group OPEC Plus me?
Right. Understanding Iran's role within OPEC Plus is key, although it's a bit complicated because Iran, while an OPEC founder member, isn't currently subject to the group's formal production quotas due to the U.S. sanctions. They're kind of exempt.
But OPEC Plus as a whole, they control a huge amount of oil, right?
Oh, definitely. The group that's the original OPEC members plus allies like Russia collectively manages a very significant portion of global oil supply. Their decisions have a massive impact on prices.
What kind of total production are we talking about from OPEC Plus currently?
According to the IEA, the International Energy Agency, the group's total output was around 41.57 million barrels per day in January 2025. It ticked up slightly to 41.78 million in February.
So over 41 million barrels a day, and they actively manage the supply.
Yes, they meet regularly to coordinate production levels. They make voluntary adjustments, cuts, or sometimes modest increases, trying to balance the market, and frankly, support prices at levels they find acceptable. The US EIA, for instance, forecasts only very modest growth from the group in 2025, maybe 0.1 million BPD, showing that tight supply management strategy.
And we hear about specific adjustments sometimes, too.
Yeah. One source mentioned OPEC discussing ongoing voluntary changes, like a planned 411,000 BPD increase coming online in May 2025 from certain members. It shows they're constantly tweaking things.
Okay, so OPEC Plus is pumping over 41 million barrels a day. Iran, you said, is producing around 3.28 million. What percentage of the OPEC Plus total does that represent? Does it give Iran much clout within the group?
If you do the math, Iran's 3.28 million BPD comes out to roughly 7.9% of that total OPEC Plus production figure from early 2025.
Almost 8%. That's, well, it's not insignificant, is it?
No, it's definitely not marginal. Even operating outside the quota system, Iran remains a substantial producer within the broader context of the alliance. They carry weight just by virtue of that volume. Now, their influence in actual decision-making might be somewhat limited by the sanctions and their exemption status, but the barrels themselves matter.
That 7.9% share is important context, but the sources also hinted that Iran used to have much bigger ambitions within OPEC, didn't they?
They certainly did. One source reminded us that while nearly 8% is notable, it's quite a bit lower than where Iran has been historically and where they aim to be.
What was the goal?
For years, they talked about regaining their position as the #2 producer within OPEC itself, second only to Saudi Arabia. That kind of goal would have meant reaching production levels up around 5.6 million barrels per day, maybe even aiming for that by 2025.
5.6 million compared to 3.3 now. That's a huge gap.
It is. And they also talked about covering a bigger slice of the global pie, aiming for maybe 7% of total world supply, which is a different calculation than just their share of OPEC plus dairy.
So why haven't they reached those goals? Is it mostly the sanctions?
Sanctions are overwhelmingly the primary reason cited in the sources. The restrictions have severely limited access to investment, foreign technology, equipment, maintenance expertise, everything you need to not just maintain, but significantly grow production capacity over the long term. So their current 3.28 million, while a recovery from the absolute depths, is clearly constrained by those ongoing pressures.
So they're an important player by volume within OPEC plus dairy, but their potential and their standing are heavily impacted by factors outside the group's control.
That sums it up well. Their reality is shaped as much by geopolitics and sanctions as by geology and OPEC policy.
Okay, let's pivot now to some very current events mentioned in the sources, these recent attacks on Iranian infrastructure. How have those impacted the oil situation, especially global prices?
The sources draw a pretty direct line between these recent attacks and the upward pressure we saw on oil prices. Specifically, Israeli bombardments reported around June 13, 2025, are pointed to as a likely contributor to the price jumps around that time.
And that's because the market gets nervous about supply.
Exactly that. Any attack on energy infrastructure in a major producer like Iran immediately sparks fears of supply disruptions. Even if the actual damage isn't immediately clear or widespread, the fear itself is enough to add a risk premium to the price. Traders react instantly to that kind of news.
What specific places were mentioned as targets in these recent incidents?
The sources listed several significant targets, which really highlights the potential impact. They mentioned sites related to the massive South Pars gas field. Now, that's mostly natural gas, but it's Iran's biggest energy asset and heavily interconnected with oil infrastructure.
So hitting gas infrastructure can have knock-on effects. What else?
Major refineries were also reportedly targeted. And as we just discussed, refining is a key strategic priority for them, so hitting those facilities is significant. And even sensitive sites like the headquarters of the Iranian Ministry of Defense were mentioned.
That raises the stakes considerably. Was there detail about the damage?
One source, the New York Times, added a worrying detail reporting that these attacks caused fires that were actually threatening nearby residential areas. So potential impact beyond just the energy sector.
Okay, targeting refineries, major gas fields. The sources also seem to really emphasize the vulnerability of one particular spot that's critical for exports.
Yes, and this is arguably the Achilles heel for Iran's crude exports. Karg Island. It's an island terminal out in the Persian Gulf.
And almost all their oil goes through there.
Historically, yes. The sources state that nearly 100% of Iran's crude oil exports pass through the terminals on Karg Island. Now, they are working on that Gurjask pipeline project we talked about to create an alternative export route on the Gulf of Oman.
To bypass Hormuz.
Right. But as of early 2025, Karg Island is still overwhelmingly the central hub. Its strategic importance is huge, but that also makes it incredibly vulnerable. Any significant disruption there, an attack, an accident would immediately cripple their ability to export crude oil.
That's a massive concentration of risk in one place. And speaking of risk and potential disruption, what's always the biggest fear when conflict escalates in that region, especially concerning shipping?
It always comes back to the Strait of Hormuz, that narrow waterway between Iran and Oman. It's the nightmare scenario for the global oil market.
Why is it so critical?
Because an unbelievable amount of the world's energy flows through it every single day. If Iran were ever to retaliate to attacks by, say, trying to mine the strait, or using missiles or drones to hinder traffic, or even just creating enough risk to scare ships away, the impact on global supply would be catastrophic.
Do the sources give numbers on how much energy actually transits Hormuz?
They do, and the numbers are staggering. In 2024, something like 20% of the entire world's oil supply went through the Strait of Hormuz. That's about 14 million barrels of crude oil every single day.
14 million barrels a day through one narrow strait.
And it's not just oil. Around 21% of the world's liquefied natural gas, LNG, also goes through there. So if that choke point gets significantly disrupted or closed, even temporarily, It's an immediate massive supply shock to the entire global energy system.
What kind of price impact could we realistically expect from that kind of disruption, or even just from the infrastructure attacks significantly cutting Iranian supply?
The price reaction would likely be severe, potentially extreme. One source estimated that losing even, say, 2 million barrels per day of supply, maybe from infrastructure damage alone, which is about 2% of global supply, could cause noticeable price increases.
And if Hormuz itself were affected?
That would amplify things dramatically.
Hmm.
If that 14 million BPD flow is threatened, you could see prices spike by tens of dollars per barrel, maybe very quickly. We could be talking levels not seen in many, many years. It's the kind of event that throws all forecasts out the window.
And it's not just the price of oil itself, is it? There are wider economic ripples.
Absolutely. The sources remind us of that too. Higher oil prices feed directly into inflation. It means higher gasoline and diesel costs for everyone, yes, but also higher costs for manufacturing, for transportation, for agriculture, basically everything that uses energy.
Which is pretty much everything.
Right. So it can lead to higher prices for all sorts of basic goods and potentially slow down economic growth worldwide. The impact goes way beyond the energy sector. It hits household budgets and national economies everywhere.
A very stark reminder of how interconnected everything is and how sensitive the global economy remains to instability in that part of the world.
Definitely. It's a constant vulnerability.
Okay, so we have these vulnerabilities, potential for disruption. If Iran's oil does get significantly knocked offline, maybe sanctions finally bite much harder, or attacks cause major lasting damage, are there other countries capable of stepping up? Can anyone compensate for that lost volume?
Yes. The sources indicate there are a few key producers who hold what's called spare capacity. That means they have the ability to increase their production relatively quickly if needed.
And who are these key players with spare capacity?
The names that come up consistently in the sources are Saudi Arabia, the United Arab Emirates, UAE, and Russia.
Saudi Arabia, UAE, Russia. Okay. How much spare capacity are we actually talking about? Do we have a sense of the volume they could theoretically bring online?
The EIA estimated that the OPEC group, which includes Saudi Arabia and the UAE but not Russia, which is an ally, had around 4.6 million barrels per day of spare capacity collectively in 2024.
4.6 million BPD, that's a lot. That sounds like it could cover even a major disruption from Iran.
It's a significant buffer, yes. And remember, Saudi Arabia was already producing around 9 million BPD in 2024, and Russia around 9.2 million BPD. So these are massive producers already, and they have this additional capacity potentially on top of that. Theoretically, they could add millions of barrels back into the market fairly quickly.
Okay, so the physical capacity seems to be there, at least on paper. But is it a guarantee that they would turn on the taps if Iranian oil disappeared? Or is it more complicated than that?
It's definitely more complicated. The sources are quite clear that having the capacity and choosing to use it are two different things. It's not an automatic replacement.
What factors influence their decision?
Several things. Prevailing market conditions play a huge role. Is demand actually strong enough to absorb the extra oil without crashing the price? But even more importantly, it comes down to the internal policies, the economic calculations, and the geopolitical strategies of Saudi Arabia, the UAE, and Russia themselves.
They coordinate within OPEC plus.
Right, exactly. They make these decisions collectively within the OPEC plus framework. And their primary goal, usually, is to keep prices stable, or rather, high enough to meet their own revenue needs, so that they'd have to weigh the benefit of stabilizing the market against the potential impact on the price they receive for their own oil.
So they might be hesitant to flood the market and push prices down, even if there's a shortage.
They could be, or they might choose to release capacity slowly, carefully managing the impact. The bottom line is the capacity exists, but the political and economic will to deploy it fully and immediately is a strategic choice, driven by their own national interests and their collective OPEC plus goals. It's not just a technical switch they flip.
That makes a lot of sense. The ability is there, but the decision is strategic. And that decision-making brings us neatly to this fundamental clash of interests you mentioned earlier.
Right. The U.S. versus OPEC plus on oil prices.
Exactly. The sources really highlighted this basic difference in what they want. Let's start with the U.S. What's the general preference there regarding oil prices?
The sources consistently indicate that the United States generally prefers low oil prices.
Lower prices are better for the U.S. economy?
That's the core reasoning. Low oil prices mean lower costs for American consumers, most obviously at the gas pump. That frees up money for other spending. It also reduces costs for businesses across the board, transportation, manufacturing, farming, which helps keep inflation down and generally supports economic growth. Think of it as an economic stimulus.
Okay, so lower prices benefit the U.S. consumer and the broader economy. Now, flip side, what about OPEC plus fight? What's their preference?
It's the complete opposite. OPEC Plus fight, whose members are heavily, sometimes almost entirely, dependent on oil export revenues for their national budgets, aims for high oil prices.
Purely economic motivation for them, maximizing revenue.
That's the primary driver, yes. Higher prices per barrel mean more money flowing into government coffers. This funds everything from social programs to infrastructure projects to diversifying their economies, ironically often away from oil dependency in the long run.
And they use their production management to try and achieve this.
Exactly. Those coordinated production cuts or managed increases we talked about, that's their main tool. They try to adjust supply to keep the market tight enough to support prices at levels they consider favorable, which are generally much higher than what the U.S. would prefer.
So you've got this built-in structural conflict. The world's biggest economy wanting cheap oil, and a cartel of major producers wanting expensive oil. It's a constant tug-of-war.
A fundamental tension in the global energy market, absolutely.
So how does Iran's specific situation, is constrained production, the potential for disruption, play into this U.S. versus OPEC plus dynamic?
This is where it gets really interesting and kind of counterintuitive.
Hmm.
Anything that reduces Iran's production or exports, whether it's successful sanctions enforcement cutting off sales or physical damage from attacks taking barrels offline, fundamentally tightens the global oil market. Less supply available.
And basic economics says tighter supply usually means.
Higher prices, exactly. So a reduction in Iranian oil tends to push global oil prices up.
Which directly benefits.
OPEC plus A. Higher prices mean more revenue for all the other members of the group, perfectly aligning with their main objective.
Okay, but wait. The U.S. is imposing sanctions on Iran partly to hurt Iran financially, right? To cut off their oil revenue. But if those sanctions or related conflict succeed in taking Iranian oil off the market, it pushes prices up, helping the rest of OPEC Plus make more money while simultaneously hitting American consumers with higher energy costs. That seems problematic for U.S. goals.
It is a complex and potentially contradictory dynamic. The source material explicitly flags this divergence. The outcome of reduced Iranian supply, higher prices, benefits OPEC Plus financially. But that same outcome increases costs for U.S. consumers and businesses, running counter to the U.S. preference for low prices.
So the policy aimed at pressuring Iran can have these unintended economic consequences that conflict with other U.S. interests.
Precisely. It illustrates just how interconnected things are. Actions taken for geopolitical reasons against one country can ripple through the global market in ways that create economic headwinds elsewhere, even for the country imposing the pressure. It's a constant balancing act with difficult trade-offs.
A clear example of how geopolitics and economics are deeply intertwined in the oil market. There are rarely simple cause and effect chains.
Very true. The ripple effects can be quite complex.
Okay, let's bring this down to the immediate market. We've talked about tensions, attacks, supply fears. Where were oil prices actually trading around the time of these recent events, say mid-June 2025?
According to one of the sources, Trading Economics, the price of crude oil was hovering right around $73 per barrel on June 13, 2025. The specific number mentioned was $72.98 a barrel.
$73. And how had the price been moving leading up to that? Was it stable, going down, going up?
The period right around mid-June was marked by some pretty significant volatility, specifically a sharp upward move. On that day alone, June 13th, the price reportedly jumped over 7%.
7% in one day.
Yeah,
Yeah.
big move. And looking at the month leading up to that point, prices were up over 15%, so a strong recent rally.
But how does that fit into the bigger picture for the year? Or historically?
That's where context is crucial. Despite that strong rally in June, the price was actually still down for the year, over 6.5% lower than where it started in January 2025. And needless to say, $73 is a long, long way from the all-time highs we saw back in July 2008, when oil hit nearly $150 a barrel.
Right. Perspective is important. And didn't the sources also mention a dip before this recent rally? Prices were lower in the spring.
Yes, that's right. The IEA report specifically mentioned that earlier in the spring, around April and May 2025, benchmark crudes like Brent had actually taken quite a tumble. Brent apparently traded down around the $60 per barrel mark at one point in early May.
So the 73 level in June was a recovery from $60, plus this extra spike driven by the geopolitical news. Definitely sounds like volatility.
That's the key word, volatility. Sharp swings up and down.
So based on the sources and the forecasts they mentioned, does this recent jump towards 73 $3 signal that we're entering some kind of sustained long-term bull run in oil prices? Are we heading back towards $100 plus let?
The consensus view presented in the sources seems to be. No, probably not. The assessment is that the current price action is more characteristic of a period of high volatility driven by short-term news, geopolitical jitters, market sentiment, rather than the beginning of a durable, multi-year upswing.
What are the forecasts suggesting then?
Well, the EIA forecast, looking out over the whole of 2025, projected an average price of around $66 per barrel for the year. That suggests they see the current $73 level as likely being an upswing within a volatile range and expect prices to average lower over the full 12 months.
And looking even further out.
The forecast actually suggested a potential further decline in the average price, down to around $59 per barrel for 2026. So the overall expectation seems to be for continued volatility, maybe within a $60–$80 range perhaps, but with a longer-term bias towards somewhat lower prices, not a sustained boon from where we are right now.
Okay, so volatility is the name of the game, not necessarily a new supercycle. Now, for someone listening to this, maybe an independent investor trying to make sense of this choppy market, did the sources touch on any potential ways to approach this? Any investment angles mentioned?
One source did briefly touch on this, yeah. It outlined a few potential avenues an investor might consider if they wanted exposure to this market, and this is crucial, always stressing the inherent risks involved.
What kind of avenues?
It mentioned things like investing in the stocks of major oil companies. ExxonMobil, Shell were given as examples, companies whose profits are often linked to oil prices. Another route mentioned was trading oil futures contracts directly, which offers high leverage but comes with very high risk.
More direct speculation.
Right. Then there are ETFs, exchange-traded funds that track oil prices. The USO fund was mentioned as an example there, that offers exposure without dealing with futures directly. And lastly, it mentioned investing through commodity-focused mutual funds, citing a large manager like BlackRock as an example.
So, a few different ways someone could potentially play the volatility, but you mentioned a big caveat about risk.
Absolutely paramount. The source was very clear to emphasize that investing in the oil market carries significant risks. You have the normal commodity market risks, supply-demand shifts can be rapid. But on top of that, you have this huge layer of geopolitical risk we've been talking about.
Sudden events moving prices dramatically.
Exactly. Military actions, political decisions, unexpected disruptions, these can cause sudden, unpredictable, and sometimes massive price swings that have nothing to do with underlying economic fundamentals. So while there might be opportunities for profit and volatility, the sources strongly caution that these come with substantial and sometimes extreme risks.
Definitely something for any listener considering this space to keep front and center. Risk management is key.
Couldn't agree more, especially in a market like this.
Okay, let's circle back and try to tie a few of these threads together now, focusing again on that absolutely critical Iran-China relationship. We know China is buying huge amounts of Iranian oil despite sanctions. What happens if that flow gets seriously disrupted? If those exports to China were cut back significantly, maybe sanctions finally get teeth, maybe attacks cause lasting damage. What's the immediate impact on global supply?
It would be a major hit to the global market balance simply because the volumes are so large. If you take, say, 1.3 to 1.4 million barrels per day of Iranian crude, which Reuters said was over 90% of their exports and mostly going to China, if you suddenly remove that from the market, you've instantly tightened global supply by well over 1 million barrels a day.
That's a big hole to fill.
It is. Other buyers globally would suddenly find themselves competing for a smaller pool of available oil, putting immediate upward pressure on the whole system.
And what would China itself do? If they lose that major source of crude, where do they turn?
China, being the world's biggest oil importer, would have no choice but to look elsewhere and quickly. The sources suggest they'd likely ramp up their buying from other major suppliers.
Like who? The usual suspects.
Pretty much. Saudi Arabia, Russia, maybe even the United States, countries they already buy significant amounts from. They'd simply have to increase their demand from those alternative sources to make up the shortfall from Iran.
And if China suddenly starts demanding more oil from Saudi Arabia, Russia, the U.S., what does that do to prices?
That increased competition for barrels could definitely push global prices higher. If China's out there bidding more aggressively for non-Iranian crude, it increases overall demand relative to the available supply, especially if, as we discussed, the spare capacity held by countries like Saudi Arabia isn't released quickly or fully enough to meet that extra demand on top of everyone else's needs. More competition for limited barrels tends to mean higher prices for everyone.
So tighter supply, more competition, likely higher prices. Does China have any ways to cushion that blow for themselves?
The sources do mention a couple of factors that could help China mitigate the immediate impact domestically. They've built up substantial strategic petroleum reserves, or SPRs, over the years. They could potentially draw those down to smooth things over in the short term.
Buying themselves some time.
Exactly. And longer term, China is investing massively in alternatives, electric vehicles, renewables. While that won't eliminate their oil needs overnight, it does gradually lessen their overall import dependency, potentially making them slightly less vulnerable to these kinds of supply shocks down the road compared to, say, a decade ago. But the immediate global price impact would still be very real.
Okay, so China might have some internal buffers, but the global market would still feel the pinch. Now, how would this scenario, less Iranian oil for China buying more elsewhere, likely pushing prices up, affect other parts of the world, say the US and Europe?
The impact would definitely differ based on whether you're primarily a producer or an importer. Let's take the U.S. first.
They're a huge producer now.
Right. The EIA forecasts U.S. production at something like 13.4 million barrels per day in 2025. So for the U.S. oil industry, higher global prices resulting from a tighter market could actually be a net positive. More profits for domestic producers, maybe more drilling activity.
But what about for everyone else in the U.S.?
That's the downside. Higher global oil prices mean higher gasoline prices for American consumers and higher energy costs for U.S. businesses. That can fuel inflation and squeeze household budgets. So for the U.S., it's a mixed bag. Potentially good for the oil patch, but painful for consumers and the wider economy.
Okay, a split impact in the U.S. What about Europe?
Europe is in a different boat. Unlike the U.S., Europe is heavily dependent on imported oil. So for European economies, a significant rise in global oil prices just means a bigger energy import bill, plain and simple.
So mostly negative for Europe?
Generally, yes. Higher energy costs would likely feed straight into inflation across the Eurozone, potentially hurting consumers and businesses, reducing competitiveness, and possibly acting as a drag on overall economic growth. For Europe, the economic fallout from reduced Iranian supply and the resulting higher global prices would probably be more uniformly negative than for the U.S.
It really drives home how these shifts in one part of the energy market, driven by things like sanctions or attacks in Iran, can send economic shockwaves across the globe, affecting different regions in quite different ways.
Absolutely. It's a truly globalized and interconnected system, and disruptions anywhere tend to ripple outwards everywhere.
Okay, let's try and pull all of this together now. We've covered a huge amount of ground in this deep dive on Iran's oil situation in mid-2025. Based on all the source material, what are some of the absolute core takeaways we should leave our listeners with?
Well, I think first we've seen Iran is maintaining pretty significant production around that 3.3 million BPD mark, which is a recovery from sanction lows. But they're still operating under heavy pressure that's curtailed their historical output and definitely their ambitions.
And they're pushing hard on refining domestically.
Right, that strategic goal of 130 million liters per day of fuel capacity. It's about self-sufficiency, but also creating new export options for refined products, not just crude.
Their crude exports, meanwhile, are overwhelmingly going to Asia, specifically China.
Yes, and using that interesting pricing tactic, charging premiums in Asia where demand is strong, but offering steep discounts elsewhere to try and move barrels in tougher markets.
And that China flow depends heavily on those teapot refineries.
Crucially, yes. The independent teapots who seem willing to navigate the sanction risks, often using that dark fleet of tankers operating under the radar. The specific data we looked at really illustrated that.
And within OPEC plus URA, Iran's still a big player by volume, around 7.9% of their total output, even though they're exempt from quotas and falling short of past goals.
Then there's the impact of recent events. Those attacks on infrastructure, South Pars, refineries. The sources link them directly to recent price hikes due to supply fears.
And the Strait of Hormuz remains that massive potential flashpoint.
The ultimate wildcard. Any disruption there would be huge, given the sheer volume of oil and LNG that passes through.
We also saw that while others, like Saudi Arabia, UAE, Russia, do have spare capacity, maybe 4.6 million BPD in OPEC alone, actually using it to compensate for lost Iranian oil isn't automatic.
No, it's a strategic decision for them based on their own price goals and market view. The capacity exists, but the will to deploy it is conditional.
And underlying all of this is that fundamental tension. The U.S. wanting low prices for its economy, OPEC plus wanting high prices for its revenues.
And Iran's situation plays right into that. Reduced Iranian supply tightens the market, pushes prices up, which helps OPEC plus financially, but creates friction with U.S. preferences. It shows the complex, sometimes conflicting results of geopolitical actions in the energy sphere.
So, putting it all together, why is getting a handle on these dynamics so important for you listening right now?
Because understanding this backdrop, Iran's role, the sanction evasion, the infrastructure risks, the Hormuz factor, the spare capacity questions, that US-OPEC plus price conflict, it's essential for making sense of so many major headlines.
It connects directly to energy prices, inflation, global economics, geopolitics.
Exactly. It helps you understand why gas prices move, why inflation might be sticky, what's driving tensions in the Middle East. It's not just about oil. It's about the interconnectedness of our global system.
The sources really paint a picture of an oil market walking a tightrope, don't they? Exposed to shocks, shaped by sanctions and workarounds, influenced heavily by a few key players' decisions.
It's definitely not just simple supply and demand. It's this complex dance between policy, geology, logistics, risk, and strategic interest. Sanctions meet circumvention, infrastructure is vulnerable, major powers have conflicting goals. It's inherently unstable in many ways.
So, given all that inherent instability, the sources reveal the potential for sudden shocks from attacks inside Iran, the ever-present Hormuz risk, the strategic calculations of those holding spare capacity, and considering that deep, ongoing conflict over prices between the U.S. and OPEC plus center. Here's maybe a final thought for you to chew on. How truly resilient is the global oil market to a really sustained period of disruption or major supply loss coming out of this region?
That's the multi-trillion-dollar question, isn't it?
What does that underlying fragility really mean for the future? For energy security, for the path of prices, not just next month, but for the next few years? Something to think about.
It certainly highlights the precariousness that often lies just beneath the surface of our global energy supply. A lot to keep watching.